You're not broke. You're just playing in a game that was never built for you to win. While you were told to work hard, save money, and retire at 65, the richest players on the board just unlocked a $5 trillion cheat code. They didn't win by working harder. They won by changing the rules. A new law was passed. It didn't make headlines. It wasn't debated at your dinner table, but it just reshaped the future of global finance. It's called the Big Beautiful Bill, and it quietly rewired how money moves in the world. With this bill, the US government can now legally shift wealth from the poor to the rich, not just inside the US, but across the entire planet. Think about this. If one country prints the global reserve currency, and everyone else still needs that currency to trade, what happens when that country decides to rewrite the rules? You don't get to vote. You just pay the price. This isn't just politics. It's a financial war, and most people are losing without realizing it. On the passive path, we show you how to read the map, how to get off the hamster wheel, how to stop reacting and start positioning. Because if $5 trillion is moving, you need to know where it's going, and how to catch some of that flow. This isn't conspiracy, it's strategy, and it's playing out right now. The question isn't whether it's fair. The question is whether you're ready to stop being the product and start being the owner. Now let's break down what this bill actually says, and why it could quietly shape your income, your savings, and your future for decades. The Big Beautiful Bill is over 900 pages long, but its purpose is simple. Make the rich richer, make the poor cheaper, make it all legal. This bill does 4 things. Each one moves massive amounts of money. Each one shifts power away from average people and toward those who already control it. First, tax cuts for the wealthy. If a billionaire made $1 billion last year, they used to owe around $350 million in taxes. Now, under this law, they might pay just $200 million. That's $150 million handed back to them. Funded by the public. Every publicly traded company in the US gets about a 15% tax break. That's not a discount. That's a profit surge. Without lifting a finger, this is why the US stock market is rising, even as the dollar weakens, even as global investors dump dollars. Wall Street is borrowing more money to buy back its own stock. That boosts prices and makes executives even wealthier. They're not betting on growth, they're betting on policy. Second, the bill slashes social spending. That includes housing support, food assistance, and healthcare funds. Every dollar not spent on the poor is a dollar that can now be rerouted to the rich. It's not saving money, it's shifting burdens. Third, the bill ramps up military spending. Billions will go to defense contractors, weapons manufacturers, and logistics firms. This is not just defense, it's business, and the contracts are already signed. Fourth, the debt ceiling has been raised by $5 trillion. This means the government can borrow an additional $5 trillion. Not to fund public services, but to cover the tax breaks, the military deals, and the wealth transfers. These 4 changes are not separate. They're a system, a closed loop of debt, privilege, and power. And unless you understand how the loop works, you'll keep spinning inside it. These aren't random decisions. They're deliberate levers, and someone is pulling them right now. The money is moving, it's not waiting. And neither should you. Next, let's break down how these levers affect your actual savings and why your bank account is quietly bleeding value. When the government gives tax breaks to billionaires, it doesn't just hand them cash. It gives them more power to buy assets. Real estate, stocks, private companies, assets that go up in value while your dollars go down. Now combine that with slashing public benefits. More people get pushed out of safety nets. More people need loans, rent help, or credit. That creates desperation, and desperation is profitable. Predatory lending spikes. Low-wage labor becomes more common, and inflation quietly eats away at your purchasing power. Meanwhile, the government raises the debt ceiling. That means more borrowing. But here's the twist. The Federal Reserve isn't printing more money to fund it. So where does the money come from? From investors around the world. From pension funds. From retirement accounts. From your savings. When the US borrows trillions from the global market, it sucks money out of the system. This isn't stimulus. It's a vacuum. Imagine a giant pump pulling water out of a lake. Now imagine that lake is global liquidity. That's what's happening now. The Fed isn't adding new money, it's shrinking its balance sheet, it's burning cash. So when the government borrows and the Fed refuses to print, they drain the pool. Less money is available. Credit gets tighter. Interest rates rise, and guess who benefits? The ones who already have access to cheap capital. Billionaires borrow at 4%, you borrow at 28% APR. That's not capitalism. That's hierarchy. And that hierarchy is enforced by policy. The more you understand this system, the less you get caught blaming yourself for struggling. This isn't a failure of budgeting, it's the outcome of design. And that design is starting to crack. Next, let's talk about the global fallout. Because the US is not borrowing in a vacuum. It's triggering financial chaos around the world. Do you like this personality? When the US government raises its debt ceiling, it starts issuing more treasury bonds. These bonds are sold to investors, countries, and institutions. But there's a problem. The demand is drying up. Global buyers are losing interest. Japan holds over $1 trillion in US debt. So does China, so do pension funds and insurance companies around the world. But now those assets are losing value. As more bonds flood the market, prices drop, yields rise. That sounds good for new buyers, but terrible for existing holders. If you bought a bond at 2% last year, and this year new ones offer 5%, your old bond is worth less. And if you need cash, you're forced to sell it at a loss. This is what's happening globally. Institutions are dumping US debt, not because they want to, because they have to. As interest rates climb, as currencies weaken, as insurance companies and banks face liquidity pressure, they're forced to offload. In Japan, the yen has strengthened, so US bonds denominated in dollars look worse. A company that promised returns to Japanese customers suddenly finds its American investments underwater, so they sell, even if it means losing money. Multiply that by dozens of countries, it becomes a global fire sale. The value of long-term US bonds drops even more. Yields rise even higher. But here's the kicker. Some investors love this chaos. People like Warren Buffett aren't buying 30-year bonds, they're buying short-term treasuries. Why? Because they pay 4 to 5%. They're low risk. And when the panic hits, they'll be first in line to reinvest at the bottom. While the world scrambles, they earn passive income. No volatility, no emotion, just steady returns from a broken system. This is why the rich don't panic in downturns. They prepare in silence. The real financial crisis isn't an event, it's a slow-motion shift. And it's already in motion. The question is, will you watch it happen? Or will you reposition before it's too late? Let's explore how money printing really works now, and why what you think of as stimulus might just be a trap. Most people think printing money means the government presses a button and cash floods the economy, but that's not how it works anymore. The real process involves the Federal Reserve, and it's more about digital entries than paper bills. When the Fed wants to inject money into the system, it buys government bonds. It credits bank reserves with newly created money. That increases liquidity. That's what people call quantitative easing. But right now, the Fed isn't doing that. It's doing the opposite. It's shrinking its balance sheet. It's selling bonds. It's removing money from the system. This is called quantitative tightening. So when the government borrows $5 trillion, but the Fed isn't printing, that money has to come from somewhere else. It comes from existing cash, from investors, from retirement funds, from banks. The pool of money doesn't get bigger. It just gets drained. This is not stimulus. This is extraction. Imagine pouring water into one bucket by scooping it from another. Nothing grows. You just move it around. But when demand for dollars rises, because the US is borrowing more and the Fed isn't printing, there's only one way to meet the demand. Someone else has to give theirs up. That's how the US ends up draining global liquidity. It's not flooding the world with money. It's vacuuming it out. And here's where it gets dangerous. If everyone starts scrambling for dollars, countries begin selling their own assets. They devalue their currencies. They issue more debt. They cut public programs. All to survive in a dollar shortage. But the US created that shortage. It raised the debt ceiling. It refused to print. And now it watches the world compete for a shrinking supply. This isn't an accident. It's leverage. And the US uses that leverage to control trade, control policy, and control access to global markets. Now here's the twist. To fix their own problems, other countries start doing the same thing. They print money, they lower rates, they cheapen their currencies, but when everyone does that at once, no one wins. Up next, let's break down how this cycle forces the entire world to follow America's lead, even when it destroys their own economies. When the US tightens its money supply, other countries face a choice. Either keep their currencies strong or print money to stay competitive. But keeping a strong currency makes their exports expensive. And if their exports are too pricey, they stop selling to the US. That means fewer dollars coming in, Fewer dollars means less ability to buy oil, food, or tech, so they're forced to let their currencies drop or they print more of their own money. But when they do that, they're playing right into the US strategy, because if everyone prints, the dollar stays strong by comparison. Not because it gains value, but because everything else loses it faster. This makes American debt easier to manage. If I owe you $10 and I make your $10 worth less, I just paid you back in discounted money. That's how inflation helps borrowers, especially borrowers who control the system. Now think about it from a global view. Countries like Japan hold trillions in US assets. If they sell, they crash the market. If they hold, they take losses. So what do? They start printing their own money. They weaken the yen. They try to offset the losses through currency manipulation. It's not fraud, it's defense. But it also fuels global inflation. Because as each country prints more money to survive, the supply of money worldwide balloons. Too much money, not enough goods. Prices rise everywhere. And once that starts, no one can stop it. It becomes a race to the bottom. Print more or fall behind. Devalue or collapse. And at the center of it all is the dollar. The US can borrow more, spend more, and print last because everyone else is printing first. This is how control is maintained, not through armies, through economics. Now let's shift to the people who understand this game better than anyone, the wealthy, and how they use these cycles to build wealth while the rest of the world struggles to hold on. The wealthy don't need to guess. They don't need to react. They plan for this. They hold cash during chaos. They buy short-term bonds with 5% yields. They sit back and earn steady returns while the rest of the market panics. They know inflation hits the poor first, and asset prices recover faster than wages. So while the middle class cuts expenses, the wealthy buy discounted assets, real estate, distressed businesses, corporate bonds. When governments and banks are forced to sell, the wealthy are the only ones with capital ready. That's how they buy low while everyone else sells at a loss. Then they wait. When interest rates drop again, because they always do, those assets inflate in value. And they win both ways. They get paid while they wait, and they get richer when the rebound hits. This is why they don't panic during recessions. They know the game, and they know the timing. Retail investors try to time the market, the rich time policy. They understand how tax cuts, inflation, and interest rates move money around. They aren't watching charts, they're watching Congress. If the government passes a $5 trillion bill, they know where the cash is going, and they get there first. Meanwhile, savers sit in cash, losing value every month. Meanwhile, employees chase wages that never quite match the cost of living. This isn't just strategy, it's access. The wealthy have better tools, better information, better timing. But you can still learn the playbook. You don't need $1 billion to think like $1 billion fund. You just need to stop playing defense and start understanding the field. Next, let's look at how this global cycle is quietly draining your savings, and what you can do to protect yourself starting today. Your savings are not safe. Not because the bank will steal them, but because their value is slipping quietly. Every time the government borrows more without printing new money, the money already in circulation gets pulled into debt. That leaves less for consumers, less for loans, less for investment. Banks tighten lending. Interest rates rise, and inflation keeps running ahead of your income. Even if you save more, your dollars buy less. That's the quiet tax. It doesn't show up on your paycheck. It shows up at the grocery store, the gas pump, your rent. You worked all year, but somehow your lifestyle shrunk. And if you're not investing in assets that grow, you're losing ground. Cash is no longer a safe place. It's a melting block of ice. You don't have to be an economist to see it. A carton of eggs used to cost $2. Now it's $4. Your bank still says you have $10,000, but what you can buy with it is shrinking every month. That's what inflation really means. And the people who benefit from it are the ones who owe money, not the ones who save. If you have $100,000 in debt and inflation cuts the value of $1, you owe less in real terms. But if you have $100,000 in savings, your money just lost power. That's why debt can be a tool when used wisely, but most people use it to survive, not to build. So how do you shift from survival to strategy? You stop saving blindly. You stop assuming stability is safety. You start thinking like the system. Invest in things that rise with inflation, income-producing assets, short-term treasury bonds, dividend stocks, businesses that grow during volatility, and above all, keep your cash moving. Dead money gets eaten. Active money works for you. The passive path isn't about laziness, it's about positioning. If you don't want to grind forever, you need to put your money where the system rewards it. Next, we'll break down where to place your capital right now, and how to avoid the traps most people walk straight into. In a system built on debt, stability is an illusion. So where do you put your money now? Start with protection, then build for growth. Step 1, short-term treasury bonds. They're paying 4 to 5%, low risk and highly liquid. This gives you income while you wait for better entry points. Step 2, income-producing assets. Think rental properties, dividend-paying stocks, or online businesses. Not just appreciation, cash flow. That's how you stay afloat when prices rise. Step 3, dollar-cost averaging into broad markets. Don't try to time bottoms. Pick solid ETFs or index funds. Buy consistently. Use volatility to your advantage, not as a threat. Step 4, avoid long-term fixed-rate debt in weakening currencies. If your debt is tied to rising rates, you're exposed. Refinance if you can. Lock in low payments. Preserve your margin. Step 5, don't hoard cash. Hold what you need. Invest what you can, because cash loses, assets adjust. And if you're investing with a 5-year mindset, these dips become discounts. Don't chase hype, chase usefulness. A business that solves real problems will still make money during downturns. A stock that pays dividends rewards you no matter what the chart says. An asset that produces cash beats a savings account that bleeds value. And don't underestimate side income. Small, consistent profits from a digital product or a niche service can add up fast. You don't need millions to invest. You need consistency. Most people overestimate what they can do in a month and underestimate what they can do in 5 years. The passive path is built on that idea. Small moves, stacked daily, compound over time. And once you're positioned, you can stop chasing every headline, because your plan accounts for chaos. Now let's look ahead. Where is all this leading? And what's the final play that could change everything? Time to connect the dots. Let's close this out with what's coming next and the steps that separate those who survive from those who build wealth in the middle of collapse. The final play is already in motion. It's not a sudden collapse, it's a slow reset. A shift in how debt is managed, how power is distributed, how currencies are valued. The US will keep borrowing because it can. Other countries will keep printing because they must. And people will keep chasing safety in a system that punishes caution. Inflation will rise in waves. Interest rates will swing, and volatility will become normal. But within that chaos, opportunity expands. The gap between those who understand capital and those who trade time for money will grow wider. Those who act early will hold the assets everyone else wishes they bought. Those who delay will sell at a loss to those who didn't. The passive path isn't about luck. It's about recognizing leverage and using it intentionally. Debt can destroy you, or it can free you. Inflation can wipe you out, or it can boost your gains. Markets don't reward emotion, they reward positioning. The new economy belongs to the prepared. The ones who don't wait for perfect conditions. The ones who build while others panic. Now is the time to protect what you have, grow what you can, and stop trading hours for pennies. Make your money move, make it work while you sleep. Make it compound without needing you in the room. That's the difference between staying stuck and stepping into freedom. This isn't about doom, it's about direction. And now you have the map. Follow the passive path. Learn the moves. Apply them simply. Repeat them often. Like, subscribe, and leave a comment with the one step you're going to take this week. Because the next 5 years will reshape everything. And you're either building or being built over.